So what I want to do now, Christy, because you have given us excellent insight there, but I want to go ahead and bring in Peter Schiff of Euro Pacific Capital to weigh in on all of this. Peter, thank you so much for being with us. Let's start off simply here. Why do you think Hong Kong, in your opinion, has become an emphasis in these trade talks?
Well, it's only because maybe the U.S. believes that it has some way to leverage what's happening in Hong Kong to its advantage and maybe to force some type of a deal. But, you know, what really bothers me about the United States criticizing China and Hong Kong, if you look at the Index of Economic Freedom that the Heritage Foundation puts out every year, Hong Kong ranks #1. Today, it's the freest economy in the world. The United States ranks 12th on that list. So, you know, I'm more concerned about the freedom of our own people. So rather than worrying about the freest people in the world, how about if our leaders try to find a way to make Americans more free?
That's a very excellent point. And speaking of free, let's talk about fairness. Trump said in an interview Tuesday, he, quote, "We can't make a deal like this even. We have to make a deal where we do much better." So does that sound like he's even trying to make a deal with that type of mentality? Like, how can he expect to hammer out a phase one when he's blatantly saying that he doesn't want a fair deal?
Well, you know, every side hopes to get an advantage. I mean, that's the whole art of the deal and negotiation. But I don't think that Trump is trying to make a deal. I mean, Trump just wants the stock market to go up. And as long as the stock market is going up, he couldn't care less about a deal with China. Maybe if the stock market really started to tank, then he might feel some type of pressure to actually deliver a deal. But as long as he can make the market go up by talking about the prospects of a deal, then that's all Trump wants.
And now it's actually interesting because, as you just mentioned, you know, the markets have been reacting. They're hitting an all-time high again today. And going into year-end, we generally have the Santa rally into seasonally strong time of year for equities. But will another escalation cause the market to crash? How should traders position for this when there is so much uncertainty in the near term? I mean, it seems like this should be causing markets to go down, but incredibly, every time he says something positive about trade negotiations, markets go to record highs.
Well, look, there are a lot of things that should be causing the market to go down, but there's really only one thing causing it to go up, and that's the Fed. And so the markets are rising. Just remember, for a while, people were worried about rate hikes. Nobody is worried about rate hikes. The Fed has taken all rate hikes off the table. The Fed has made it clear that the only direction that rates can go is down. They're either going to stay the same or they're going to go down. And QE4 is now on autopilot, you know, in perpetuity. So that's what the markets want. They know that they're never going to have another rate hike, and they're going to have money printing as far as the eye can see. And so that's what's driving stocks. And I guess that's going to continue to drive stocks until something causes that to change. And something is going to happen because the U.S. is headed for a worse economic disaster than the one we had in 2008. And there's no way this is good for stocks.
And we really shouldn't even be here at all-time highs right now when every single earnings season this year we had continuous revisions down. Third quarter print on average, equities across the board are averaging 2.3% downwards. And now we're going to 4Q, and with tariffs on board, with consumer spending expected to be much slower, much more constricted this year, how would stocks react, especially for retail consumer sentiment and everything, when consumers have been the backbone and been supporting the market this entire ride?
Well, first of all, I mean, bad earnings are not the only negative that the markets are ignoring. And in fact, in a way, the bad news is good news again because it, you know, keeps the Fed in play, even though they've basically, you know, assured the markets that they're not going to do anything to hurt the markets. But as far as the consumer is concerned, look, you know, people keep talking about how the consumer has never been in better shape when the opposite is true. The consumer is completely levered up. He's got record amounts of debt, and the only reason he can spend is because the Fed is keeping rates low enough so that credit continues to flow despite the lack of legitimate savings to finance it. So this whole house of cards is going to come tumbling down, and the consumer is going to be right in the center of that.
And Peter, I do want to ask because, you know, as we just mentioned, you know, the year end and we're in the Santa season, if you will. I mean, retail earnings have been kind of up and down depending on what you're looking at. Department stores down, Target and Best Buy kind of moving up. But what are we going to see here as we hit into the key holiday shopping season? Yet what you're talking about is a lot of concern in the economy. I mean, are we still going to see people spend that money come this week?
Well, as long as they can borrow it, they'll spend it. The question is, can they pay it back? Look, I think the holiday sales are going to be disappointing again, and certainly the brick and mortar companies, the vast majority of them, continue to struggle. I mean, look what's going on with the vacancy rates and leases, and and the earnings on most of those companies. So a lot of Americans are doing what they can to squeeze every penny out of the dollars they're borrowing, and so they're shopping online and looking for the best deal. And I guess that's going to continue. But remember, a lot of the stuff that we're buying, or probably almost all the stuff that we're buying, is imported. We're not making it. It's made in other countries. So we're buying it on a national credit card as well as an individual credit card. So whatever we spend just means larger trade deficits, and that means the U.S. economy is in an even more precarious position following holiday shopping than before.
And now finally, let's talk about gold. Poland has just repatriated 100 tons of gold from the Bank of England. And Poland's not the only one doing that right now. Central banks around the world have been on a gold buying spree, pushing it to 3-year highs. So why are central banks now stockpiling and hoarding gold? Should that be a market indicator that potentially there's a downturn?
Well, I think if you're smart, you recognize what that's indicative of. But I think the central bankers are in a position to know that a monetary crisis is imminent. That doesn't mean it's going to start tomorrow. Of course, it could. But whether it starts next month, next year, or sometime in the next several years, they need to have gold. I mean, gold ownership is going to be key to preserving confidence in your currency. And you have to back your currency by something real, not by somebody else's paper. And so that's gold. And I think what Poland is doing is a trend that we're seeing, where it's not just that you want to own gold, but you want to own possession of your own gold. You don't want to trust a third party with your gold.
Absolutely. Well, Peter Schiff, always a advocate for the gold industry, CEO of Euro Pacific Capital. Thank you so much for your time.
I'm an advocate for sound money, and that's gold.